in today's video, I'm gonna go over the details of a new loan program that's out. It's called the 1% Down Program. Now we offer this in 48 states, so let's get into it. So here's how this works. So this is actually a conventional loan where the minimum down payment is normally 3%. Now with this program, you're only going to need to bring 1%, and the remaining 2% of that comes in the form of an actual forgivable grant, and this grant is forgivable starting day one, and this actually will get applied the day of closing. Now let's go over real life scenarios, how the numbers work. So let's say that you're buying a house for $350,000. The minimum down payment that's normally required is 3%, which would be $10,500 in this example. Now with this program, again, you're only gonna have to bring 1% of the purchase price, which would be $3,500, and the remaining amount, the other 2%, would be covered by this grant, which would be $7,000. And this whole idea, it's aimed to help reduce your overall cash to close, the amount that you bring to the closing table, so that you can use that money in different avenues wherever you see fit. Now let's go over the requirements for this. So minimum credit score is really going to be about a 680. Now if you have a lower credit score, there are other grants and down payment assistance programs out there, and I actually got one for a first-time homebuyer with a 650 credit score. But again, for this particular grant, you really need to have a higher credit score, 680 or plus. This can only be used to buy your primary residence only, so you must live in the property for at least 12 months. And again, you need to qualify based on conventional loan guidelines for this grant. Now there are area limits, so you can't use this to buy a home in high cost areas. High cost areas meaning like LA or New York City, where the average home price is $1 million plus. And then there are also income restrictions. Now let's go over how to look up and how to determine what the income restrictions are. Okay, so the income that's being used to qualify cannot exceed 80% of the area median income. And the way to determine this and to look this up is you want to look at the Fannie Mae income limit tool. I'll put the link in the description, but it will break down whichever area that you're buying in. You'll put in the zip code and it will tell you here's 80% of the area median income is $76,000. So that means that the income that's being used to qualify cannot exceed $76,000 a year, or whatever it's telling you as the 80%, in order to get qualified for this grant. Now, the good thing is you can exclude what we call extra income. So like if you get bonuses, if you get overtime, and you don't need that income to necessarily help qualify, we can exclude that in order to meet the income restrictions for this type of loan. Now, let's go over more features and benefit. Okay, so here are some of the benefits. So you can add more to the down payment if you wanted to. You're not capped at just adding the 1%. If you wanted to add more additional funds, you can. Also, this is not just for first-time home buyers. It can be anyone. However, if you are a first-time home buyer, then you will need to do a very simple home education course that you can do online. And you can also use this and have the seller pay for your closing costs. Now let's go over the strategy of how to buy a house with very minimal out-of-pocket expense. Here's how one of my clients bought a home with very little cash to close out of their pocket, and here was our overall strategy. So they purchased a house for $350,000. They used this 1% down, so their down payment was only $3,500. Now, there are closing costs that are on top of the down payment, and what they did is they had the seller pay for all of their closing costs. This is a negotiation thing, and the seller paid $10,500. So literally, when it came to the closing table, they only had to bring $3,500, and they ended up using the other money to have reserves on the side so that that initial down payment wouldn't have wiped them out. And their overall goal of this was to use this to get into the house. They're going to live in the property for at least 12 months, and then from there they're going to go buy another property, rent the current one out, and continue the process. That's how they're building up their rental portfolio. So here's how to apply. You first want to get pre-approved, and you want to make sure that you're working with someone that has different loan programs and many options available. You also, during the pre-approval process, you yourself make sure you understand what all your options are and that you know exactly what the monthly payments and the cash to close for each different loan programs. so that at the end of the day, you want to make the best decision for yourself. Now again, strategy is going to be the key, and this is exactly how another one of my clients bought a home with 0 out-of-pocket expenses, 0 to cash to close. And it's because up front we had a strategy, we knew exactly what we needed to do and asked the seller in order to get this done. And if you're planning to buy a house and want to know exactly how much your buying power is, click on the link in the description, book a call, and I'll be in touch.